Okay, here we go. Week 21, predicting the financial market. If you want a transcript of today's seminar, makestocksfun.com. Our quote of the week: in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Funny with money quote: if you think nobody cares if you're alive, try missing a couple car payments. I appreciate everyone being here and spending time on your stock development. I know you want to learn how to generate wealth in retirement via the stock market. My name is Brian Reich. I'm a successful stock investor. My goal is to be a stock millionaire. In these sessions, I want to pass on my knowledge of wins and losses so you can enjoy the success I have today. Adam last week brought up a great question to end the week's seminar. Why do stocks split? And because we ran out of time, I felt like I didn't give it the attention it deserves. So, the price gets too high. That's the main reason that more people are able to afford it. Index fund requirements. So the index might require a certain dollar amount for them to join the index. Does that make sense?
Yes.
Cool. And then the other thing is, I feel, I don't want to call it market manipulation at all, but it just seems like there's hidden gems, so a lot of people are very casual of how they look at the stock and the stock market, and then when they check once, twice a year, they just kind of notice the stock is relatively about the same. And what Joe Casual misses is the stock has been going up and splitting. Can you name some companies that have split recently? Like Apple.
Recently.
Like since 2020, the last 3 years.
It's Tesla. I don't know if Tesla or not.
Yeah, Tesla is up there.
Yeah.
Apple.
Right. Microsoft, maybe?
I don't know if they had or not. That's a good inquiry. Today, I'd like to show you how to find the splits of a company because it's very essential. This is an example that I have. ZYXI, Zynex, they're in the medical industry. And what you want to do, you can just go down to all data on bigcharts.com. And then right here it says show splits under upper indicators. And you just click draw chart. Yeah, so right here, it shows that this actually split 1 to 40. So that is huge. I mean, that is the biggest split that I know of. Like Tesla did a 1 to 5, and then they did a 1 to 4 split, pretty much like back to back of each other. We can bring that up for you guys. So that's why you really want to know about this, because before investing, you want to know, if it's 40 to 1. There's probably some insider stuff going on and maybe some shady things taking place. I mean, 40 to 1 is just huge. It gives a lot of leverage to insiders or whatnot. So here, Tesla split 5 to 1 and then 3 to 1 shortly after that. So I just thought I'd share that with you guys. Predicting the future of the stock market. This episode will grab my crystal ball and predict what may happen in the stock market. First of all, we have to go back in the past, see what our friend Mr. Market has been up to in the last 2 decades. Good news, if there's profits in the market every year, presents new opportunities to make money. I put this little slide together for you guys. From 2004, the Dow Jones, low and high is $97 to 106. You started with 10 grand, 9% variance that year, you'd finish with 10,900. 2005, the Dow Jones was low at $100 and the high was 109. 10,900 at a 9% variance. You'd have finished with 11,881. 2006, Dow Jones going high was 106 to 125. Bringing your 10 grand to 1181. 18% gives you 14,000 to end the year. 2007 Dow Jones, low was 120, high 141. Started 14 grand at the year, you would end at 16.4. 2008 Dow Jones, low was 75 to 131. That was the bank crash, so that was the huge variance there. 16,000, you had 18% variance to finish at 28,826. 2009, another kind of crazy year there. The low was 65 to $105, giving 61%. That was all the crazy, bankers were getting money for the subprime loans and whatnot. 2010 Dow Jones, low was 97, high was 116. 46 grand at 19 and a half became 55,000. 2011 Dow Jones, low was 106 to 128. Start the year at 55 grand, finished at 67. There's a 21% swing between the low and the high that year. 2012 Dow Jones, low was 121, high was 136. 67 start, you'd finish at 75 grand, 12% variance. 2013, finishing our 10-year time frame. Low was 133, the high was 161. And your 10 grand start would finish at 91,000. Does everyone understand what I'm doing? I know it's predicting the market, but do you
Yes.
understand the reasoning here of why we're going back in time?
Well, the market, the indices usually go down like an escalator and up like an elevator. They go up many more days than they go down. When they go down, they go just very largely, and they climb back very slowly.
Right.
But over time, you said they make money.
Yeah, that is correct. And the variance, the thing to note too, is that the sharp drops happen like the 20-30% in a day. I mean, it literally goes zooming back up within the next day. So you have this little window to prepare yourself. And that's, like I said in the beginning, if you don't take anything else from the seminar, just learn how to plan and really think about, your nest egg or a 401k you just kind of laid around from an old job. I mean, plan it out. I mean, get it active in a new account and know what you're going to do. And that way you're ready. Does that make sense?
Yeah.
Cool. So yeah, basically to calculate, the last 20 years we're 11.2. Yeah, 2014 Dow Jones, low was 153, high was 172. 91 grand turned into 102 grand 11 years later. 2015 Dow Jones, low was 156, high was 183. Started at 102, ended the year roughly about 120 grand. 2016 Dow Jones, low was 156, high was 200. Yeah, the 119, that was a 28% variance. The 119 became 152. 2017 Dow Jones, low was 203, high was 248. Yeah, these are some big years here. 152 grand, yeah, 22% variance. You finish at 186, 354. 2018 Dow Jones, lowest 216, 268. 186 grand at 23%, you'd finish at 229. So you're at $250,000 here. 2019 Dow Jones, low was 248, high was 289. And it started 229, we turned into 265, there's a 16%. Yeah, these are all huge years back to back. And of course now, leading up into the pandemic, here we go, we're at low at 180, so we're back in time. I was 302, so there's a quick rebound. So giving you a 66% variance. So if you just hung in there, your 265 would become 441, almost a $500,000.
You'd be a hero buying at the dip, sir.
Right, and I did. That's where I became.
Yeah, that I did too.
Yeah, yeah, smart man. So 221, yeah, you're at a $500,000 now, to 21%. Climbed 100 grand in just that 1 year alone.
Yeah.
And then this year, of course, 287, 368. So basically, yeah, finished 10 grand 20 years later, 683 with a real bare minimum strategy. You know, all you're doing, you're buying the Dow Jones, the DIA is a symbol, and that follows the Dow Jones directly. So if you want just nothing else, you're fearful of stocks or what have you, you want to see how to play the stock game, I definitely recommend, you know, just something like an index. And then when it's low, you just buy in and you can see how the money could elevate.
And Brian, of course, the Dow Jones are 30 industrials. They're primarily large. They're large cap.
They're the largest companies in the world.
Yes.
You're talking about Travelers. You're talking American Express. You're talking about in 28 just behemoth companies and Dow Jones.
Honeywell, United Healthcare, huge. Yes.
Yeah, just absolutely huge companies. And I always just follow the joint. You can do whatever though. S&P is fine, NASDAQ is fine. You know, whatever you want to get into, whatever you follow. I just, for whatever reason, I just gravitated toward the Dow. You know, I had a coworker at the time, and he told me with the reasoning, and ever since that, in the early 2000s, that's just what I compared the market to. But going forward, you can see what the market would have done for you, and of course, you know, if you take advantage of stocks, you elevate that much quicker, you gain wealth that much faster. But can anybody see why this train would derail going forward for the next 10 years?
You know, I look for influx problems in the U.S. If something happens overseas, I'm not really worried about it.
Right.
But anything in the U.S., you know, assassination, you know, things like that, you know, major problems in the U.S. I look at.
Right. But I was talking more like what would stop the stock market? I mean, these are good points to bring up for a crash, and you definitely want to be ready when something happens. But what would stop the stock market from being as kind to the investor like you could see?
Interest rates.
Yeah, like maybe a debt problem. Yeah. Right. Maybe Social Security. Everyone talks about it. Right, the Social Security benefits won't be around. They're mentioning a date that you want to pay attention to, 2033. They're saying that 25% reduction with all retirees getting Social Security that are on Social Security. So, and we know that's been a problem decade after decade. It's nothing new.
Yeah.
You know, they've been spilling that since the 80s. And, you know, there's always a news clip about how they're not going to have money. They're going to run out. And something like that. So, I mean, that's something to keep an eye out. But what about like Web3? Like, what if the stock investors become more into crypto? You know, like that. Wouldn't that affect the stock market? Or would it become a point where, you know, I don't know, that there would be some radical changes? I mean, these are a good point. I mean, the Web3 is just, you know, under development. You know, crypto is relatively new since 2012. But, as we're getting, 5G and everything else, it's just something to pay attention. One trend I noticed is, people are turning more entrepreneurial now, starting their online businesses or their side hustles. So it's just something to keep note of. Anybody else have anything to add in other than like meteors crashing into the earth?
Maybe there's a potential that people would rely on these companies less for one reason or another, because that's what they really are. Is these companies are so big because people need their services or their products, and if there's some sort of change in the way of life that makes it so that people don't need these companies, I don't know what that would be.
Right. Yeah, it all comes down to impact, right? Like how Apple has changed our life. If you lose your phone, that's like death, right? I mean, you scramble around and you instantly think where you left it, or you visualize, payment problems, pictures you put on there, videos, everything, right? So I mean, these companies have huge dominance. There's a very valid reason, because it impacts human lives in the way it does. And so far, it's all been on the stock market. So as long as it keeps on, then you could put, it's just well noted that the stock market should have good success going forward. And I put this together for you guys as well. And basically I changed this into like the film you just watched. But so basically since 2004, and what I did in October 6th, I noted what the prices were throughout the years. Like if you want any of this information, I'll have it on a blog, and then also you can feel free to, subscribe to the website, because there's a lot of content in today's episode. But then the whole thing we're getting to, is the future. And so this set us all up for what we want to discuss now, where we're going forward. I believe the stock market going forward, there really isn't anything other than like a meteor hitting Earth or some bizarre thing. We want to keep an eye out for various things as they happen. But I predict there'll probably be a minor crash somewhere here, maybe 2025, 26, somewhere in this area. And I think a crash maybe because of Social Security in 2030. I feel that if you go back in time, all these percentages on top here are all variances, how the market varied. And if you just did an average, it's 26% in the first 10 years, and then 24% in the second 10 years. So basically 25%. So I'm going to stick with that going forward. I'm going to say there's going to probably be a 25% variance going forward with these years. And then just figuring on that, I think next year will probably be something. The Dow again, will probably be maybe hit as low as 325. I think next year is probably going to be a boom year. I think we'll probably get into the 380, 370, 380 mark. And then from there, it just ramps up, maybe 340 variance. And we'll probably get into the 400s by 2025. And then there, I don't know what's going to stir it. There's a lot of things. Could be just student debt in general. Maybe Trump is president. I don't want to speculate. I'm not a politic guy. I'm just saying maybe something he did, or maybe some president does. We'll just put it that way. And that's kind of how I see it playing out. I just think there'll be a 25% on average variance next 5 years here, and look out for a minor correction. And we might get back, maybe get somewhere here around the 290, maybe 280. I don't think we're going to get back like pandemic, 180. But then again, who knows? New wars, another thing we didn't really talk about, but that could definitely have a panic, especially with AI. Maybe something accidentally gets triggered that maybe even like human type of things. So there's just a lot of things to keep your eye out. Does that make sense?
Mm-hmm. Are there any things that you feel like to look for that would indicate that we're in the lower of the spectrum of variance?
Not really, because there's just so many different factors that go into it. And at the end of the day, it's buyers and sellers. Sometimes there's a sell just something that steers the market the wrong way, and that could cause a sell-off. Maybe something Apple did. Maybe they said they're changing one of the directors, and that may make a notion, and then people just start selling Apple. It's just things like that. That's why I'm not really a news person. I pay attention, but I don't really dive too deep. I dive into the numbers because that's where the money is. When you boil stocks at the root, it's just percentages. These are all just percentage gains. So as the stock goes down or the market goes down, I just put in my money just thinking that long term that we're in a safe boat. Does that make sense?
Definitely.
Cool. Yeah, I really enjoyed the seminar. I put some good stuff together for you guys. I hope you enjoyed it. If you can, give me a 5-star rating, tell a friend, because the more people get involved, the more positive a group we can have and everything. The one last thing I was going to leave it on is my Instagram page. I put a lot into this. There's a lot of good content here. I put a book coming out. It's called 82 Companies. I want to form like a little club for like-minded people. You can make new friends and things like that. But a lot of good resources for you guys in the coming months here, and I enjoy being with you guys. I hope you have a great weekend.
Thank you.
Excellent. Thank you.
Thank you so much, guys.
I like your contrarian way of thinking.
You got to stay positive, my friend. The world will drown you out if you don't.
I do the same thing. Don't follow the herd.
Right, exactly. Exactly. Thank you,
Take
Dave.
care.
Appreciate your input.